Almost no one, including professionals, can outperform the stock market over a long period. Passive investing through index funds and ETFs is clearly more advantageous than active investing in individual stocks. The results of passive investments are higher, and the risks are significantly lower. This means that passive investments through index funds or ETFs are obviously more beneficial than active investing and buying individual stocks. The results of such investments are higher, and the risks are significantly lower. For example, over the past 10 years, about 80% of US investment funds have performed worse than the index. Professional managers can't beat the market, so our chances are even slimmer. You can't rely on luck, as there is no guaranteed strategy to outperform the market. While some anomalies in the past have yielded high returns, there is no reason to believe this will happen again. There is another reason not to buy individual stocks. Their results are usually very poor. The market grows thanks to a very small number of companies with incredibly high returns, but predicting which companies will become giants is nearly impossible. For instance, 20 years ago, the largest companies of that time are no longer in the top 10 US companies, and their results are worse than the market. Even if you buy 10 individual stocks, the likelihood of picking a future giant is extremely low. It's better to buy the entire index through ETFs to maximize your chances of success. But why is there so much talk about picking individual stocks and active portfolio management? In this video, I will name several reasons that play a significant role. The first reason is intermediaries. Imagine being a broker. A significant portion of your profit comes from client transaction fees. If clients buy an ETF once a month, you won't earn much. However, many of them don't understand the stock market, and you could give them investment recommendations so they buy and sell different stocks, earning you a commission on each transaction. Some brokers also create portfolios of stocks that outperform the index by chance and advertise them to clients without mentioning that it's purely coincidental. Thus, brokers create the illusion that the market can be beaten and make their profit from commissions. The second reason is cognitive biases, such as survivor bias. We see people who have outperformed the index and don't notice those who lost. On social media, people write about their successes, many of which are random, but losers write nothing. This creates the illusion that beating the market is possible and that it is due to their professionalism, not random luck. Statistics show that even among professionals, those who win are often just lucky. This is especially true for amateurs who believe their success is due to their skills. Nobel laureate in economics Eugene Fama argues that 10 or even 20 years of fund returns are not enough to determine if the manager was lucky or skilled. So when you see a professional manager who has been outperforming the index for 10 years, it is likely due to chance. Imagine a blogger who has been investing for a couple of years and outperformed the market, not doubting that it was not by chance, although their analysis doesn't compare to the real work of professionals. Active investors in the media space are often random winners who attract attention and are considered experienced. But the point is that beating the market by chance is not a sign of professionalism. If you follow active investors, you're likely looking at someone who won a bit of money in a casino. The third reason is interest. A typical financial blogger can create a lot of content about individual stocks, business news, financial reviews, and this is much more interesting than simply buying an ETF once a month. Trading individual stocks is a gamble, and people like it, especially if someone convinced them that they can beat the market with their intellect. Discussing the successes and failures of individual stocks is much more engaging than just tracking the index. As for mutual funds, their work is also interesting. Imagine we own a company with 10 managers managing 30 portfolios. After 3 years, only 7 of them outperform the index, the rest we close, and a potential client only sees the successful portfolios. This is manipulation of statistics, and you can find many mutual funds with good results on the internet, but they are competing against each other, not against the market. Avoiding buying individual stocks is difficult because investing in ETFs sounds like admitting defeat. But statistics show that this is the most rational approach. Your portfolio may be boring, but it will yield more income in the long run. If your goal is fun and excitement, buy individual stocks. But if you want to invest like a professional, choose only ETFs and forget about the existence of individual stocks. No one benefits from you investing rationally except yourself. If you want to build your initial capital but feel that you lack financial literacy and knowledge of investment strategies, I suggest you subscribe to my channel and write the word investments in the comments. I will send you a detailed guide on investments and an effective strategy with 3 ways to invest your money so that it generates passive income for you throughout your life, all for free. The money will truly start accumulating in your accounts, and you will have more of it. Check it out. Write investments in the comments and start learning.